Oh, hello there. I didn't see you come in. I was updating my status on Facebook. Speaking of Facebook, I have the Facebook 10K here for the fiscal year December 31st, 2019. We're going to go through Facebook today and we're going to evaluate two different methods, the free cash flow method and a market multiple, enterprise value to EBITDA. And we're going to come up with what we think the stock price should be and then compare it to the market today and see if it's buy or not. This is Rational Investing. My name is Cameron Stewart, CFA. Here we look for a couple things. Let's go through our guidelines on how we evaluate a stock. First and foremost, we look for a stock that has strong top-line revenue growth. We're looking for positive free cash flow and earnings growth, both of those, low debt, and lastly, we want a stock that's well priced before we get in. That's what we do here at Rational Investing, and I'm glad that you're watching along. We're going to walk through Facebook. As I said, this is the 10K. You should go through and read all of it. It's incredibly important, especially if you're going to invest. And you should understand what's in there and make sure the investment's right for you. What we're going to do is we're going to go through and let's look at the free cash flow method. So I've taken the liberty of going through not only this 10K, but 10Ks for the last decade to give you perspective on Facebook so you can see at a glance what Facebook has done over the last decade, and maybe that gives us a clue on what's going to happen in the next decade. There's obviously no guarantees here, but we use history as a judge and we try to have a big enough time frame to smooth out some of the ins and outs. What you'll see here is we've got cash flow from operations. Now that's cash money that they generate every single year. In this instance, $36 billion of free cash flow in 2019. Now you're asking, where did you get this? I got this from the 10K, and I got this from the cash flow statement. What I also got from the cash flow statement is the CapEx. Now CapEx, as we've discussed previously, is investment that Facebook makes to continue its operation year in, year out. In this case, it was $15 billion. The neat thing about Facebook, it has zero long-term debt. One of the few companies trading out there, and there are a handful of them, that has zero debt, and it's nice to see in this instance. So when we sum this up, we get $21 billion of free cash flow that Facebook generated last year, and you can see the growth over the decade has been tremendous. And that's important in its current valuation, and it's important in how we look at it going forward. But $21 billion is essentially free cash that Facebook could dividend out to shareholders. It could use to buy back stock, or it could make an acquisition if it wanted to buy something else. But basically, it's not going to affect how the business runs because it's already it's free. It's free cash flow. That's why it's so interesting. And this is truly the holy grail for investing, what you're going after. And if the market's priced right, this is really what the stock price in the market should be based on. All the passion aside of what's going on day to day, in the long term, you should be holding close to that number. Shares outstanding, 2.8 billion shares. It's grown slightly over the decade, aside from early on when it looks like they issued some stock. But for the most part, it's been pretty stable. The free cash flow to the equity holders on a per share base, $7.43. That's the per share value of that free cash flow. So it's $21 billion divided by 2.8 billion shares. Each share you buy entitles you to $7.43 of free cash flow. What they chose to do with it, it's up to them. The stock price at the end of December, here I'm just averaging for the month of December in 2019. Stock price was $205. I divide these two, you get a yield, 3.6% to give you, on average during December, the stock was yielding 3.6% free cash flow. What has that done over the year? You can see it's fluctuated a little bit, but it's been very consistent year in, year out. Low of 0.7. High of, say, 4.1 here for an average of 2.8% yield. And we're going to use this in the future. It's a nice value. It's been benchmarked for a decade. It has a pretty good understanding of where it can range from. The last bit is the growth rate. It's just interesting to note exactly how big that has grown over the last decade, and an annual average rate of 85%. That's tremendous. Kudos to Facebook and the team for getting that done. So let's go forward and say, what does this look like if we move this forward in time and try to forecast a value for the stock? So remember, we're going to pull this yield number here and this growth number there, and we're going to pick up on the free cash flow per share right there. So let's scroll over and look at our forecast. The forecast picks up 2020 with a forecast free cash flow to equity of $9.33. This is 25% growth off the previous $7.43 number. I'm haircutting the 25% as I go down for time. Given that it's grown at 85% historically, I'm starting at 25 and going to scale down for an average growth rate of 16.5% over the next decade. So the previous decade it grew at 85%. Here I'm saying it has to manage 16.5% over the following decade, which I think is fairly conservative. This number aside, the 9.3 is probably too much for the current coronavirus that's going on, but over the long term, again 10 years, that's why we look at a 10-year horizon, it smooths out some of those market volatile days or months or weeks or quarters and gives you a long-term perspective. Because ultimately, if you buy this stock, you got to hang on to it for a decade. And you're buying because you want to own it long-term, not because you think you're going to make a buck in a day. Nobody knows what the stock price is going to do tomorrow. But at least with this math, we can begin to understand where we think it's going to go 10 years from now. So what this says, it says I take 9.3, I grow it at these rates for a decade, I should get 33.87. And when I do in year 2029, I can value the stock price by saying I got an average yield here of free cash flow of 2.8%. My free cash flow in this year is going to be 33.87. Therefore, the stock price is $1,224 in a decade. That's one way to value Facebook. And again, there are multiple ways to do here. I'm going to pick two, and we're gonna walk through them. The next way to value Facebook is to look at the enterprise value to EBITDA method. Here, I've got the enterprise value and the EBITDA for the last decade. So first and foremost, what was the first rule in our investing? We're looking for top-line revenue growth. You can see revenue here, $3.7 billion a decade ago, all the way to $70 billion in 2019. That is outstanding growth, and we like to see that. Operating income is our base, what we're going to begin our EBITDA calculation. And again, you can pull these from the 10K. That's exactly what I did. EBIT, earnings before interest and tax, $23 billion. Depreciation, $5.7 billion for an EBITDA of $29.7 billion. I didn't do any other adjustments or add backs. I thought Facebook was pretty clean and their P&L represented their general run rate expenses, so there was nothing to add back. $29 billion of EBITDA, an EBITDA growth rate, 54% growth rate. Now that growth rate is very consistent with the free cash flow growth rate that we saw earlier, which is a good sign. It means if you're looking at two different financial statements, the cash flow statement previously and the profit and loss of the P&L statement now, they're generally going in the right direction. That's a good check on their accounting principles. Growth rate. Now let's build up enterprise value. So enterprise value, what we're going to do is we're going to begin with the debt. In this instance, they don't have any debt. Kudos to them. That's a good hallmark for us. That's what we look for. Excess cash, that's remarkable. Excess cash of $35 billion. What does that mean? That means that they're generating so much cash, they're not actually spending it all fast enough. They're not dividending it out, and they're not buying back shares. They're storing it. And right now they have $35 billion in cash on hand, which, excess cash. That's not even total cash. That's just what you would give out if you bought the company as a whole. Market cap, again, that's shares, basic shares times price for the market value at the time of the year. And then I add these up and subtract the debt, and I get the enterprise value. Enterprise value of $550 billion at the end of 2019. And I'll do a simple valuation metric of what we discussed. In enterprise value to EBITDA, that's enterprise value divided by EBITDA. And why do we do this? Because this is if you wanted to buy the entire company. You'd have to pay off the debt. In this instance, there's no debt. The shareholders that before they sold you the company, they would distribute this cash to themselves because it's cash they generated in prior periods. And then you could buy the company for the market value. In this instance, it would cost you in total $550 billion, or 18 times this number. So that's a way of thinking about how to value the company. In this case, we're going to forecast going forward. We're going to pick up on the EBITDA number, $29 billion. We're going to look at the growth rate of 54%, and we're going to look at the enterprise value to EBITDA metric. So, EBITDA, $33 billion in 2020 is our estimate. I'm growing that at 13.8%. Again, that is less than the historic growth rate we've experienced of 54%. So right off the bat, I'm haircutting and saying, you know what, we're going to grow similar to we did the prior year of 25%. Excuse me, a lot less than that. We're going to start at 13.5. And for the decade, we need to average 9.3%. So again, I think that's reasonable. If they've grown, 30 some odd percent in the first decade or the previous decade, and now we're saying 9%, I think that's extremely reasonable, actually. So they grow this number, and in 10 years, there's $71 billion in EBITDA. And we're going to value that at an 18 times. Why 18? Well, because in 10 years, their growth rate would have slowed. So they don't deserve a high multiple like 25% because they've become so big they're slowing down. So I'm giving a market multiple of 18, which is a realistic number for a company that's doing $70 billion of EBITDA. And at this point, it's probably kicking out hefty dividends to their shareholders. An 18 times multiple is a reasonable estimate. I've said that they've continued to have zero debt, and that the cash estimate is $79 billion on hand. And then that gives me a market cap of $1.3 trillion. Fully diluted shares still outstanding, 2.8 billion, for a price of $477. So now we have a range. We've got two different prices for our stock. We've got essentially $1,200 and essentially $500. That's what we're saying the range could be. That's a pretty broad range. That's more than an extra full turn of the low end. So that's a wide range, and you can see it's that wide because the historical growth has been so fast, so high. It's very hard to predict what's going to go in the future. And so here I'm giving you a range. I'm saying, okay, low end, call it $500. High end, call it $1,200. Someplace in there, I think the stock could be in a decade. So what I do is I split the difference and say I'm going to go ahead at $850 is the price target in a decade from now. Okay. Currently, the stock is trading at $160 a share. So you could buy it right now at $160 a share, and in 10 years, that share should be worth $850. Now, what does that look like from an IRR perspective? And I think this is quite attractive. Let me get this in full screen so you can see it. All right, here we go. 2020, this is the free cash flow that I've already calculated for you. It shows what you could expect as a theoretical dividend each and every year. You're buying the stock today at $160, so your first year, you're in it for $150. You're going to receive that dividend, either share buybacks or distributed to you as a dividend. And in the end, you're going to sell your stock for $850, combining the two for $884 in total return that year. If I do an IRR calculation on all of this, that internal rate of return is a 28% compound annually return. What does that mean? That means I put in the money today, and if I hit this price in a decade, that means I would have earned 28% interest on my investment every single year for a decade. That's fantastic. That's hard to beat in the market without just pure speculation. But to have it based on fundamentals like this seems very rational to me. This is a breakdown of the cash. If you got the cash distributed, I'm just summing that up. That's $213. The stock gain is the difference between these two. It's $690 for a total cash back to you of $900 approximately, or 6.7 times your money. That's a cash-on-cash return. Outstanding. We think here at Rational Investors that this is a good stock to own for the long term. Again, we approach investing as though you're marrying the stock. You're going to buy it, you're going to own it, and you're buying it for a particular reason, not just because you think it's going to go up tomorrow or someone on TV said earnings should be good next quarter. We don't care. We're not in the business of flipping stock. You pay too much in taxes, and then you have to find another good investment to do with that cash. So what we look for is, how can I invest my money for a decade and double, triple, quadruple my money? In this instance, 6.7%, 6.7 times your money would be the estimate. Cool stuff, huh? Let's do some fun math. So let's say you're in your 20s or 30s or 40s. You've got a job, you're grinding away, doing your work, you're paying your taxes, just like all of us, trying to scrimp and save to get money that you tuck away into a savings account, and you hope maybe in 20, 30 years you can retire. Good plan, everyone does it. Let's see what it would take to be a millionaire. This is a math exercise based on this math exercise, so anything could change. But it's fun to think about it, especially if you're putting money in the market. What do you need to do to achieve a particular goal or objective? This is how we can do it. So let's say, for example, you wanted to be a millionaire. At the end of this investment, in 10 years, you wanted $1 million. And we're saying that the end price is going to be either $1,200 or $470. Well, how many shares do I have to buy? How much do I have to put in today to be a millionaire in a decade? Well, here you go. If you think the share price, or if the share price ends at the high end of the range of $1,200 per share, you buy 817 shares today at the current price of $160. If that happens and you achieve the $1,200 a share, you would have put in $130,000, and it'll equal $1 million. Pretty cool. Same thing, if the share price falls on the low end of the range, you need to buy $330,000 worth of stock at $160 a share to equal $1 million. So you've got an investment range here that you need to target to be able to hit the $1 million over the decade. Pretty neat. I know $130,000 or $330,000 is a lot of money. It's certainly a lot of money in one stock, but it's a lot of money. So be cautious with that. But I will say one thing. A decade's a long time. The market generally tends to perform well over the decade. And recently, this stock price has been hammered, coming off its highs. So if you believe in the stock, you've done the numbers, check it out, see what you can do. But have a target in mind when you make an investment. Have a goal, a long-term vision for the price. It'll really help you when the market moves up and down. You won't be panicked and try to get out of it. You'll believe in your investment because you bought it for the long term. Thank you very much. This is Cameron Stewart, CFA from Rational Investing. Thanks so much for your time.